do you need to raise? And that might be a funny question, but for a lot of projects, it might not even make sense. Okay, so hello everyone, I'm Elena. I'm going to cover a very special topic for all startup founders today, is how to raise from VC. For some startups who did it in the past, sometimes it seems to be obvious, but everyone is repeating same mistakes. The market is changing, and I want to tap today into several topics underneath how to raise from VC, which will help you not only to structure your pitch, but also to understand who is your target investor and how to find this person. Before that, I just wanted to tell you why you should even spend time listening to me. So I actually come from venture capital background. My journey in crypto started in 2014. I have been working with our traditional tech projects. I was advising United Nations on how to use emerging technologies to improve financial inclusion. So I've been working with a lot of startups in Southeast Asian region, helping them to scale and grow. I also spent several years in VC, built consulting company with a focus on small and medium-sized businesses, and help startups to raise over 20 mil. And for the last 2 years, I've been fully focused on Supermoon, which is a community of founders, builders, and investors. And right now we have over 18,000 people in our network. We already helped founders to secure more than 15 mils through our events. Those are more curated, founders and investors focused experiences. And this year we're actually expanding a little bit more. So we will be working with founders on their fundraising, on the personal introductions, and of course helping them to structure their raise in a way they're not getting in trouble later. And to give you also a little bit of more information, I'm not going to delve into these projects. There's some of the projects we worked with. Some of these projects raised money from our events. And we have over 1,500 investors in our network, including all top-tier players in crypto, Web3, but also traditional players, angel investors, family offices, and more. And talking about how to raise from VC. So I always want to start with the very, very basic questions that every founder should ask before you even approach any of our VC. And the first question is, do you need to raise? And that might be a funny question, but for a lot of projects, it might not even make sense. If you can bootstrap, if you can get enough resources through other channels, sometimes it's better. Because raising funds, it comes with losing equity. If you're in a rush and trying to secure investors faster, it can also affect you long term. It can affect your future raise. It can affect your exit. It can affect the healthy development and growth of your company. And I will cover it a little bit later. The next question you should ask is how much you need to raise and what for. You don't want to raise more than you need because, again, at the beginning, at the pre-seed stage, you're going to be giving a bigger amount of equity for a smaller amount of money. So you want to be smart about your cap table. You want to be smart about how you're structuring your round. And that's why you need to have an absolute clarity on what you're raising for and how much you actually need. You also need to understand what help you need. Because money is easy. And some founders will say, maybe not, I'm struggling to find. Money is easy if you know how to find them. Capital is available from so many different sources. But what founders need is not just money. You need a network, you need resources, you need strategic partnerships. And that's what separates their top-tier players, top-tier VCs, and VCs that don't have enough resources and network. Is actually this ability to help projects to build strategic partnerships. Because yes, you can get money. And if you look at the success ratio of top-tier investors compared to tier 2, tier 3, you will look and start wondering, like, why top-tier investors are getting such a great ROI on their deals. Is it because they're making smarter decisions? In many cases, no. It's because they also have a wide network, they have a big brand name, they have a big reputation. So for their portfolio companies, it's easier to succeed. And that's why you need to know what help you need. And of course, to understand who's your ideal investor. There is no point of cold calling investors if they're not touching your industry. If you're working in AI and you're trying to approach investors that are looking for traditional business, they're never going to look at your project. If you're trying to go with your traditional project to Web3 investors, they're going to be asking you completely different questions and they're not going to look at you. They're not going to care. And that's going to be a waste of time for you and for investor. So that's why you need to understand who is this ideal investor is. And one thing that a lot of founders forget, and unfortunately a lot of investors are forgetting, your early stage investor is actually your potential partner and potential co-founder. That's how you need to treat them. And that's why VC space became, I would say, it's now so far away from how it was before, when a startup will come to an investor and an investor will treat startup as essentially their child. VC will be like a parent who would bring startup in. They will help to provide more resources. They will bring you to the right conversations. They'll be there with you on a weekly basis, providing their advice and expertise. And it became broken. Right now, investors are throwing money into a bunch of projects and let's see who's going to succeed. Is it the right approach? No, because again, it takes more than money for a project to succeed. It takes a lot of network, efforts, and resources. And that's why you always need to keep in mind that investor is your partner. Treat him as a co-founder, because in this case, you will find the right investor for your company if you start looking at them from this angle. Also, like coming to a question, raise or not to raise, I really like bringing example of Squarespace that actually started in 2003 and they were bootstrapping all the way. They never raised the capital. I think they got like initial commit like of 30K from family and friends just to start the website, hosting, all initial operations. They were pretty much self-sufficient, all until they decided to go for more aggressive expansion and raised 38.5 mil from pretty renowned, reputable investors. And that story is not the only one. I believe MailChimp was doing a similar. GitHub also didn't have enough capital at the beginning. There's a lot of stories out there. So raising is not a necessity. You need to be very smart and wise with your capital. Sometimes, yes, it can take you a longer time to be where you are, but you're going to be there. Sometimes projects are trying to rush and raise faster, raise like bigger amount of money too soon, and they fail because they cannot deliver. And when you come to Series A, let's say if you're coming after your seed stage, you didn't deliver well for your Series A round, and you're doing down round. That's when investors not going to look at you because no one wants to take additional risk. And then that actually can resolve in your project failing. So being very smart about raising any round is very, very important. You have to think long term, not about your current state, but about Series A, Series B, and further rounds. And that's why I'm always saying about speed versus quality. Because if you rush with anything, it's usually not good. It might get you a little bit ahead of the game short term. You can be ahead of your current competitors, but let's say you are not doing enough testing, you are not getting enough feedback from your user base. It actually gives your competitors an advantage to learn from your mistakes and be ahead of the game long term. So short term, you might have, okay, I'm getting a sign that I need to speak louder. Thank you, Austin. So yeah, you actually, short term, you might actually seem like you're winning. You might have a bigger revenue. You might generate more traction short term. But long term, your competitors will outdo. And what is the point of building a project if you're going to fail in 1 or 2 years? You need to be smart about your long-term journey. And of course, that's why you want to also think about the types of the raise. And I'm just listing like a few here. The classic ones are angel, accelerator, VC funds, and other. You need always to compare pros and cons. So the easiest and quickest that you're going to do when you're just starting and you need to raise, again, you need to raise. If you don't need to raise, obviously you don't need to. But if you decide that you want to go and get outside capital, angel investors, if you have in your network, family, friends, anyone who can support your business, your vision, someone from your closest network who people can introduce and bring potential angel investor. That's usually faster, comes with a smaller checks, usually between 10 to 50K, sometimes more, sometimes less, depending again on angel raise. But usually it's the fastest for you to do, and it also can come with an interesting network and resources, but you want to be, again, careful about who you're bringing in, because some angels might be pretty hands-off. They might give you additional expertise, resources, introductions. They can introduce you to VC funds who you will need a bit later, since you're already starting your fundraising journey. But at the same time, you can get a bad actor, a person who will jump in, take a sufficient amount of equity, and then would like to participate, and not necessarily in a good way. This person can also affect your current development. The person can waste your time, can provide your feedback that you don't really need. And all this can, of course, bring a negative impact on your business. So be very careful about who you're working with. Accelerators. If you're looking for more, I would say, like fast-paced environment with other entrepreneurs who are working on other projects, it's a good place where you can get, I would say, startup culture, where you can get some sort of knowledge. But I personally think accelerator is becoming a little bit outdated. Back in the days when YC was starting their accelerator, there was just not enough information about startups, about venture capital. So you could get a lot of knowledge on how to structure your startup, let's say how to work on your go-to-market strategy, financials, how to approach your next round. They will organize private events, bring more investors. They will actually help you to grow. Y Combinator also started to grow very fast, and a lot of startups, I think the value just started diluting. Also, a lot of information now available online. There is more events happening at your location where you are based. You don't necessarily need to be in the valley to access all this information from like a top accelerators. You can also watch it online. And usually a lot of accelerator programs starting at a specific period of times because they have a cohort, and it also can slow you down. And on top of that, it tends to be a large amount of equity for a smaller check. So if you think you can get a really good value out of this program, don't measure it by money, don't measure it by this check, because that's not going to be a good deal. Measure it by other resources that you can get. It might be potential clients, potential experts that can advise you, let's say, on growth strategies, or bring you another resources that will be helpful for you long term. So that's the only reason for you to consider accelerator. And of course, VC funds. VC funds is usually more challenging for early stage projects. VC funds take, on average, longer time to consider any incoming deal flow. And of course, there is more due diligence, but bigger checks. And you will be facing with VC funds a lot if you're starting to raise capital. So we will talk about VC funds in a bit as well. And talking about your raise, and was covering on actual financials, a good way for you to understand if you need to raise is to actually start structuring your use of funds. And here I gave like random examples, not necessarily the categories that you might have, but that an example of a pitch deck and use of funds slide there. So when you start building up your financial projections, that's where you can start evaluating, okay, what skill set I'm missing in my company. Let's say you're a user-facing application and you don't have a strong marketing and go-to-market specialist in your team. That's something you want to consider hiring, because your scalability and growth of your company will depend on this key persona. So of course, that would be a part of your use of funds. If you're a tech project and you're raising your seed or pre-seed stage, I would normally expect you to spend a big fraction of your funds on tech development, just because you're building a tech project. So it would be weird that you're not spending enough money to develop a sustainable platform for your application. So of course, categories will vary depending on your business model. On a slide here, you will not, for investors, you will not present a lot of different categories. I usually recommend to stick with 4 or 5, just to show them their distribution. But at the same time, you should have a very well-defined financial projections. And sometimes startups would ask me, well, like, what's the point of me doing financial projections? Like, I have no idea what's going to happen, like, in 6 months and 1 year. And for tech projects, maybe a timeline is a bit more, I would say, predictable. For Web3 industry and crypto, it's impossible to predict. No one knows what's going to happen tomorrow. So startups saying, like, how I can even put these numbers. And I'm saying no one expects you to actually predict the future. Everyone knows that projections not going to work the way you are. You're going to pivot. You might pivot 10 times before you actually find your product market fit. But the thing is about financial projections is I can actually evaluate the founder really well just based on your financial projections. I can see how ambitious you are, how much of research you did, how well you understand your market, how well you understand your business model, and how scalable it is. So that's kind of things that I want to see. I know things are going to change. You might also test out different business models, which I also want to see in financial projections. If you're testing out different scenarios, I want to see what current stage you are at and how much money you are planning to earn. And a lot of founders don't understand that. I see sometimes very, I would say, unambitious financial projections where founders are aiming to earn too little. And of course, it doesn't make any sense for you to invest in the project. The founder doesn't put any ambitious goals. What can be your ROI from your investment? So that's why be very careful when you do financial projections. It's not because people trying to judge how well you predict the future, but they're judging you and your ability to build a project through these numbers. And one thing that a lot of people forget about, that most investors can, and many actually will waste your time. So you can have so many calls with our VC investors, which not going to resolve into anything. And it's not because something wrong with your project, but because investor was taking this call already knowing they don't invest in this industry, they don't care about this business model, or they don't care about your project. But this particular investor is just also very curious person. Very curious person who wants to know more about what is out there outside of their scope of interest. And he will spend a lot of time having conversation with you. It can be an hour chat. He will do a follow-up just to learn more information. Sometimes investors see that, okay, we have a portfolio project that is working on something similar. Why don't we talk to a potential competitor and also learn what is like what they're building, and maybe can grab some ideas. This is like a least possible scenario from that. The most likely investor just want to learn more, but it's going to be a waste of your time. And that's why I was saying how important it is to understand who is your ideal investor, because raising funds is a full-time job. Startups on average taking 50, 60 calls with investors before they receive their first check. 50, 60 on average. If you have less connections with VC funds, then it's going to be way more conversations. And of course, you want to minimize this number and focus on those who actually care and potentially can invest in your project. Another thing is also listen, but stay focused. So currently, we were advising a couple of projects that are not even Web3 projects. So one of the projects is AI, the other one is entertainment. I'm not gonna mention the names. And these projects are jumping on a call with me and saying, okay, we had a conversation with a few investors from crypto, and they're saying we need to add token right away because now is everything about TG, token generated events, right? And I'm saying, no, guys, like you don't need token. It doesn't make any sense, like in your business model. Of course, you can always find a way, right, to add a trendy or new technology, or you can add like a trendy new buzzword to your startup. And short term, yes, you can actually get money because these investors will give you money because they're looking right now for any token projects, or they can go for TGE, again, token generated event, and they can get a quick liquidity and exit from their funds. What's going to happen to startup is that investors going to be dumping this token, so the market will not be really happy about it. People will be, majority of people who are your potential users, your potential customers, will be pretty angry, and they will look at the project that the project is not doing well, there is no interest, maybe we shouldn't work, we shouldn't use, we shouldn't touch this project at all. And you will spend years of making sense out of this token and trying to find a way how you're going to plug it into your existing business model. In alternative, you don't need to do that. You can focus on your existing business, on your existing ideas that you're already validating. And maybe you're not going to be getting a quick funds from those investors, but you're going to take funds from a more serious investor who want to support you long term. And in a couple of years, you're not going to be facing with all these angry people. You're actually going to be growing faster, get more users. Yes, it might take additional time, but patience is a key. If you look at all big projects, everyone who got like multi-billion-dollar valuation, their journey wasn't fast. They weren't coming to market, and in 6 months they were getting crazy amount of checks from all the reputable investors. No. They spent 2 to 3 years to reach a level when they can actually show a solid validation, and then they would get solid investors in their round, and then they will start generating more and more traction. And of course, that's how we all know about those projects. So be very, very careful. And for that reason, I'm also saying that the only feedback that you actually want to listen to as a priority is the feedback from your target audience. You're building it not for those investors. Most of those investors might not be your target audience. They don't care about your project at all. You want to rely on feedback from your target audience. And that might be really obvious, but honestly, I would say 80% of projects I talk to are getting really frustrated. They're getting a different feedback from different investors, and then I see how their business model changing, how much more functionality they're adding more features, they're spending time on development before they actually testing it out with their target audience. And that's a big mistake because you can endlessly change, improve your project, you can endlessly add new functionality, but you don't need to. The simpler you launch, the better it is, because your first conversation is not necessarily with someone super sophisticated who tested out a bunch of projects like yours. It might be with a day-to-day user who just needs to solve a real problem. And you want to focus on that problem instead of trying to add a lot of confusing functionality, which actually might drive your audience away from you because they will be very confused, they will not understand what you're trying to build, and they will just leave your app. And for you, it will be very, very hard to understand what the problem is just because you cannot understand, was it the function number 1 or feature like number 2, feature number 3, right? You have so much things going on. Anything can be wrong, and anything can be very, I would say, undesirable for your target audience. So you want to get this feedback as soon as possible. And of course, last reminder about chasing trends. I don't know of a project that would just switch into hypey, trendy things and suddenly succeed. No, it's not usually how it's happening. So yes, again, short term, you can get additional traction, you can get additional marketing. And that's what, remember, during NFT hype, a lot of big brands were adding NFTs. No one is really doing anything with NFTs. If you notice right now, they were just adding these trendy words just to get more media marketing exposure. And of course, it worked for that specific purpose. It wasn't a part of their business model. They didn't rely on that as a part of their business model. They were using it as a marketing trick. So one thing is using something as a marketing trick. The other thing is building your business model around a trendy, hype words, buzzwords that are appearing every year, especially in the crypto space. And for that reason, I'm always saying, look for smart money, because you can get just money. But again, always look at the values that you're getting by trading away your equity. One thing that you cannot easily get back is your equity. One thing that you cannot easily fix is your cap table. If you have bad players and unreputable investors on your cap table, I want to see you trying raising your next round. It will be a very, very, very tough thing for you to do, is to try and go after more reputable established investors and saying, hey, we have this investor who doesn't really do anything, they are not supporting us, they have a bad reputation, they have a bad portfolio projects that most of them failed. Now you're trying to raise funds. So of course, they're not gonna take you seriously. They also will look at your cap table and see, okay, you gave away so much of your equity for such a low amount of money. So that means you're also undervaluing yourself, or you don't understand like how much your equity actually worth. And those conversations, they're not gonna mention it to you. They're not gonna be completely transparent. They will just say to you, oh, I'm sorry, we're not interested, right? But for you to know a reason, your cap table actually matters so much for your next rounds. And that's why I'm saying you not only want to think for next couple of months how you're gonna go and try to build your project. You also want to think what's going to be happening in a year, in a 2, in 5, in 10, how you actually going to be monetizing and how you also going to be delivering a value to your existing investors if you took the VC fundraising route. One of the most important things is, of course, network and connections. If you notice, a lot of our projects, I would say unicorns that started raising capital from reputable investors very early, it's not because they're necessarily a brilliant genius and have such a great, unique idea. Sometimes they have a good idea, but the idea doesn't really worth anything because you can replicate it very easily. They might have a strong team, but you can also find a strong team somewhere else. But what sets them apart is actually network and connections. Of course, the more network you have, the easier for you to scale your project, the less time you spend on building this network. Of course, if you want to have, let's say, I don't know, you need 50K just to kick off your project, and you don't have any personal income to put towards this project. So of course, it's easier if you already know angel investor who have enough capital, but also know enough resources and expertise in the industry of your project, because that investor can, first of all, help you with the capital that you can put towards development of your project. But also, this person can put you in a conversation with 5 or 7 more people who might be valuable for your business. It might be potential other angel investors, but what is more important is your potential strategic partners who can bring you to the next level. And you want to think about it. Then, of course, expertise. You want to work with people who actually understand your industry. It can be from a different angle. So let's say you're building, I don't know, like AI project, and you are a user-facing application. So you want to understand how to actually reach to these users with your AI application. You're not necessarily looking for someone super sophisticated in the AI space. You might be needing an advisor who already built other tech projects that are user-facing, because you want to understand how you're going to get to your first 1,000, your first 100,000, and your first million of users on your app, and that person can help you. So you want to look for unique expertise that you desperately need to scale your project. And that can come with your investors, that can come with their portfolio projects, and that can come with their network. So you want to carefully analyze who these investors are and what kind of people, what kind of companies are in their network. And of course, reputation. That's what I already covered on. You don't want to work with investors or with any partners, with anyone who have a bad reputation, because that will affect not only your business or scalability, but also potential relationships with other partners who you need for your business. And for that reason, I am usually focusing on a very quick questionnaire on know your investor, and I'll just put all those questions here. So you want to see, first of all, what is their area of interest. You want to understand, again, that there's an alignment with your investor, because before you have this alignment, you're going to waste time, because they're not interested in learning about your industry. It's not their sweet spot. It's going to be just a waste of time for both of you. You want to see what is their area of expertise, again, because we just discussed that that's something that you need. You want to understand decision makers and their background, because those are going to be people you are talking to. So of course you want to understand where is it coming from, what are their interests, because you want to have a normal conversation. You don't want to just cold pitch to an investor, because that's not how it works. You also want to see other things that you have in common, and that can be portfolio projects, other connections. You can even scope through your LinkedIn, through other social media networks, and just see who else can help you to get in touch with these decision makers. Because personal introductions come with a completely different value compared to you cold calling or cold emailing these investors. And what can help, if you don't have anything in common, just figure out where is it going to be. Figure out what kind of events are your target investor going to attend, go to these events and try to talk to them. And starting a conversation, of course, comes with two ways. You can meet an investor at an event, and that would be the first time you're going to be pitching. I'm going to talk about it on the next slide. First is about sending your pitch deck. And as easy as it seems to make a pitch deck, all founders actually struggle. It's way easier for me to look at the founder pitch deck and change it in a way it would be presentable for investor. When I was a founder, I had a nightmare building my pitch deck. It was very hard to understand what exact message I'm supposed to put, because I'm seeing my project from so many different angles that it's harder for me to figure out what the message should go on the pitch deck that investor can understand it, because I know it way deeply. So I would ask some of my friends, some of my colleagues, and say hey, can you fix my pitch deck? Because I cannot do it for myself. And that is actually a common problem. So for founders, it's way harder to work on the pitch deck. You're trying to get more, add more information there, but it's becoming really overwhelming. So first of all, try to be as short and concise as possible. Average reading time is 1 minute, if you're lucky. If investor was reading you for 1 minute, it means they were interested and they probably are going to follow up with you. If they drop out on the first 2 slides, then obviously it's probably you either didn't explain well what you were working on and they were bored and they quit the deck, or it might be just not an area of their interest and that's why they didn't want to really read anything that comes after it. Yeah. And if you see that investors spend 15 minutes on your deck, it's probably because they went to grab a coffee and they were just hanging on your pitch deck. No one's going to spend that long. Be specific right away. So your first slide is the most important because that's where you want to be as clear as possible about what you're building. Don't try to use all these ambiguous words, successful, disrupting. Doesn't have any meaning. Be very specific on what you're trying to build because your first slide going to determine if they're actually interested and going to look into your presentation. Include, of course, include numbers and names. So you want to show any traction, any numbers that you have. It's not only how much you're planning to earn, how big is the market, but any numbers that you already generated, you can add there. Even if you think it's like too little of a number, let's say you onboarded 100 new users, but it's been only like 2 days since you launched. Just put it in the perspective, say 100 new users within 2 days after launch, and keep updating it. If you're sending the same link to an investor, it gives you an opportunity to keep updating the same link, and you can always follow up and say like, hey guys, remember we mentioned we had 100 users within 2 days? Well, guess what? Now we have 1,000. So that would be an amazing way to follow up with investor. And don't be afraid to follow up if you have something valuable like traction. Nothing is more valuable than traction. You want to add your financials as well for that specific reason. You want to show how you actually going to earn money throughout the time, and you want to show them a little bit more long-term projections. Don't get too crazy with financials. You can add, like if you have more information, you can always add it in appendix or share it with your data room. But try to put key numbers that is very visible and clear to understand for every single investor. There is one format that majority of investors like. I've heard a few that wanted something more creative and not standard. So what I usually recommend is to have a couple of versions, sometimes more versions, depending on what type of investor you're talking to. A lot of traditional players would ask for Sequoia Capital. This is a standard pitch deck flow that majority of projects use. Of course, you can rearrange some parts of this presentation. But essentially, yeah, the first thing that you want to say is your company purpose, is what you do, why you're doing it, and you want to be very concise, ideally with one sentence. You have problem, solution, which actually, that's another thing that a lot of projects forget about. They start adding a bunch of different problems.
Is your presentation available somewhere?
Yeah, it will be available. So we're going to share it. Yeah, we're going to share it with everyone today. So yeah, for the problem, startups start listing a bunch of problems. And I was asking, like, why do you do that? And they're saying, but I'm just worried that this problem is not big enough. And we have so many different solutions. If you think that some of the problems is not big enough, you need to think better, because maybe you're not finding a right problem on the market that is scalable enough. There should be one problem that you are solving with one solution. Everything else is a feature that's supporting your solution. But always remember, there can be only one problem. If there are two problems, you're already doing two different things. And that's confusing. That leads to you not understanding on how to build functionalities that actually solves this problem. And then about getting in touch with investors. So I already mentioned that, of course, personal introductions. Let me just put these things here. So personal introductions are the best way to go. If you don't know anyone in common with your target investor, you know the easiest way to do it? You go and check out their portfolio projects. You find them on LinkedIn and you're saying like, hey, I would love to chat with you about this investor. We're planning on reaching out to them, and I wanted to get your feedback. You will be surprised how many startup founders are open to help, because they were already going through the same process. They also want to maintain good relationships with their investors. So they will be happy to have a conversation with you, provide the feedback, and then make an introduction with an investor. So don't be afraid to reach out to people you don't know. Everyone was going through the same stage you did, and they will be happy to help. You can also look for potential partners, either your current partners or partners you can build in order to establish these relationships. So you can see that some potential partner been working with this investor for a long time, and that partner also makes sense for your project. Of course, you don't want to just bring partner for the sake of having a partner on your website. You want to have someone who makes sense, who can also put a good word for you in front of investor. And look for any other connections. It can be random people you have in common. You can ask your friends, you can ask your colleagues from like your previous work, your previous project, whoever you know. You can ask like, hey guys, like I'm planning on starting my race, trying to like get in touch with like specific investors. If you know anyone or you maybe hear about anyone, let me know. And people will be happy to help. Already mentioned about in-person events. It's the best way for you to meet investor. And we're gonna talk very briefly on how to actually approach those investors. And before that, just wanted to mention that, again, don't forget and don't be afraid to follow up. Of course, with their specific information. Traction, new clients, big partnerships, you brought in new investors, follow up with any investors that you're already in conversation with. And now let's talk about meeting investors in person. And one first thing that I just want to put here is don't verbally spam investors. I host a lot of events for founders and VC funds, and I see these poor investors who are trying to hide because a large amount of founders trying to run and just start cold pitching them with their entire 5-minute pitch. No one wants to do it at a private event. Private event is for you to establish relationships, for you to find the right fit and get to know a person. It's your opportunity to get to know if this investor is a potential partner for your project. If you recall the previous slide, a few slides earlier when I was talking, that treat your investor as a partner, as your potential co-founder. So that's how you want to approach them during the in-person event. You don't want to just go and cold spamming them with all information you got. You want to establish a meaningful conversation and know and decide for yourself if this person is someone you want to work with. So you obviously want to know this person. So for that reason, try to go not longer than 15-20 seconds intro. I would go even less. Like, you don't really need to mention much. If you already know this investor is interested, and me and ChatGPT put together a few examples. If you already know this investor is either in AI space or in, let's say, agriculture, I put some random stuff for everyone to kind of understand. So if you already know that this investor is interested in, let's say, agriculture space, or this person is interested in AI, you just need to mention the first phrase, and maybe like in a more friendly way, like not like as a formal speech. You can just say like, oh, we're working on some project to increase productivity for farms. And then investor will start asking you questions like, oh, how you do that? Because this investor is actually interested in the space. And then you can start mentioning, start plugging in some numbers that you got, saying like, oh, we're just like testing it out with 200 farms, already got 500K in revenue, but we're planning on doing more tests soon. Happy like to chat about it. And you can switch and say like, what about you guys? What's your current interest? You want to know this person. So establish your personal relationships. That's why, yeah, ask questions, try to build this connection with investor. And best pitch is no pitch. That's why whenever I train founders start to do investment call, I'm saying forget about your pitch deck. Investor already saw your pitch deck. There is no information there that this investor didn't see or really care about. Tell them about your story. Start showing them a demo. If you already have an MVP, what can tell better than your actual product demonstration? It's also important to handle objections really well. Investors will come with like all types of feedback. Some feedback will be, again, valuable. Some feedback will be a waste of time. You have to have a good judgment on what to listen to, what not to listen to, but always handle objections well. Always be thankful. You don't want to come as arrogant. And I saw founders who like, oh no, we know better. You know, like we already have so much great partnerships with let's say all big players like Google. Google is interested in us. We don't really care about you. A lot of founders come very arrogant. It's really bad because you can spoil a relationship with this investor, but investors talk to each other. And they also ask for additional feedback, additional recommendations are. So we, for example, jump on the calls with so many different investors depending on the startup we're looking at. Because I know if, for example, we're lacking in-depth expertise, let's say in gaming, I can always call our investor who is focused on gaming and get additional expertise from there. I can also call investors and see, hey, you previously invested in this project. We're considering bringing them and helping with investment introductions during this round. What do you guys think? Is the project as good or not? Why you didn't follow up? So all investors have communications, they always are supporting and helping each other. So you also want to make sure that you're not spoiling relationships with one of the players, because that can affect your relationships with other investors. And of course, instead of pitching, try to move towards conversation. It's more about storytelling. So let me just put all this here. So it's more about our storytelling. From a very first conversation, you want to show them why you're so passionate about what you're building. What is your story? What is this pain that you found on the market and you're trying to solve? So storytelling is the biggest help for you when you're trying to talk to investors. Because if you try to just cold pitch to them, show you slides, investor gets bored, they cannot focus on it, are they having sometimes 10, 14 calls per day. So of course, they don't want to have another like educational session or another pitch. They want to have a conversation with a real human being, because it's all about founders. Traction, nothing can speak louder than numbers that you can present. If you already have users, if you already have revenue, if you have profit, if you have anything else like partnerships, any reputable names from your network that you brought to your project, please list them. Not in an arrogant way that you're trying to say that we already got everything. No, you want to showcase that you have good relationships, you have strong team, and market is already responding well to what you're building. Then, of course, your team. Your team is the core, because as I said, anyone can replicate an idea. Idea alone is not as valuable, because all investors actually going to ask you, how you gonna protect yourself from competitors, how you gonna protect yourself from a bigger player like in traditional tech who is gonna replicate the same idea and essentially get rid of your project. So you need to show your expertise. And the best thing, of course, previous exits, but to be honest, not that many founders have previous exits. So of course, you're trying to find other things that you can present that actually showcasing your expertise. And it can be years of experience, it can be other bigger projects you worked on, it might be some niche research that you accomplished that is very crucial for your current business. Mention everything that is really relevant to what you're building. Not necessarily, you don't need to put like your entire bio there, just mention what is meaningful for what you're working on. And of course, competitor advantage, of course. You want to show how you're going to protect yourself. And that question all investors are going to ask you, and you have to be ready. And it cannot be something that like, we're just the first. No. Being the first is not necessarily the best thing, because I mentioned earlier that it's easier to replicate. Your competitors actually have advantage to learn from your mistakes and do better and outperform you long term. Because they're not looking at your numbers now. And I unfortunately saw a lot of talented teams that fallen into this problem. They started first, there was no competition in the market, they built a great solution, they were taking their time, and by that time, there were more competitors appearing, they were struggling to raise Series A round, even their existing investors didn't want to follow up, and they had a really rock star portfolio of investors. They had big names. I'm not going to name them just for sake of projects that is raising right now. They have very, very reputable names on their portfolio. big investors, big partnerships, they got users, they got revenue, but then they didn't have enough growth because there are more competitors coming on the market with better, more robust solutions, with better branding, because they learned from their mistakes and they outperformed them. And now the guys cannot raise funds, they are not generating as much revenue, they're losing users, and they're losing to their competitors. So being the first, it's not necessarily being the best. It's not your competitive advantage. So think carefully what can actually help to protect your brand long term. And one of the tips is also looking at your team and their unique skill set. Then that can also be a part of a competitive advantage. And of course, when you see this message from investors, and you will see it, we want to stay in touch. It's not the right time for us. Let's touch base during your next round. You will see this message a lot. And one question that a lot of founders asking, is it like a complete hard no? Should we just forget about this investor? Actually, no. You should stay in touch. You should follow up with this investor. The reason that they're saying it to you is because they're not sure. They didn't see enough traction. They might actually not having enough liquidity. They might not interested in adding this type of project just yet. They might need to do more research. There's so many different reasons. And in many cases, you will be surprised. Investor might not have enough liquidity to actually invest into you. But they might have it in 1 month, in 2 months, in 3 months. They also don't want to waste your time. So what you want to do is to keep in touch. You want to actually send them all your updates, all your traction, anything that you generate. So your updates are absolutely crucial. It's not appearing, okay. So all your updates are absolutely crucial. And don't try to send the gigantic emails. Again, investors receiving communication from hundreds, thousands, startups. Try to be as concise as possible. Just one sentence saying hey, hope you're doing well. By the way, to let you know, we just onboarded our next 1,000 users with that much in revenue. So any numbers can speak better, and actually when they read, they also look for numbers. So try to send, and you can send them more emails. Just keep them short. And I think I just want to stop here and start taking questions from you guys. I don't know how many of you are actually raising right now. Who's raising? I'll show you. Okay. So if you have any questions, feel free to raise your hand and ask a question about race. If you're also interested, yeah.
I mean, I have a million questions, but I don't have a lot of time. I think the first one is the know your investor portion. Say you're chatting with a VC, you find out they have a portco, they decide a position that looks like it would be a direct competitor. Say it's launching an NFT marketplace and they decide a position in OpenSea. Do I see that as an advantage because they know the market, they have the knowledge, or is it something I should stay away from them because they have a direct position and then potential?
So that's actually a really good question, because a lot of our investors disagree on that. Some investors will only, so the best way to approach it, you want to look at their entire portfolio. So if you see that they have random allocations in different type of projects, so for example, they have an NFT marketplace and they have some games and they have a payment solution. So they're not really specific, they're not really focused on a specific niche. So in this case, probably no, because they probably don't want to add additional NFT marketplace if they already have essentially a direct competitor in their portfolio. But if this fund is only interested in NFT-related projects, let's say, and already have, let's say, 2 different NFT marketplaces, you probably want to talk to them. But you also want to think on how you're going to be different from OpenSea, because if you're coming with exactly the same solution, any investor will say to you, there is no market for it. So you want to come in strong, and you want to say, OpenSea is focused on, let's say, general NFT listings, and we want to focus on this specific area.
Hi, I'm so excited that the voice goes to you. So I'm watching, you're building a very people team, and you're building something in the AI space. Now, I'm a CEO, co-founder. How important is it for me to be involved with investor meetings and business meetings compared to
So investors, that's actually what I wanted also to mention before. Investors want to talk to founder and ideally to a CEO. So you can never ask someone else to take investment meeting. Someone else can like put a good word and make an introduction for your project, but the main investment meeting should come from a founder and CEO. Just because they want to see who is leading this project, they want to get to know you, not other team members. They will want to know other team members, but later. But initial call, it always should be founder and CEO. I mean, ideally to have you both on a call. If you're very serious about this specific investor, both of you want to be on a call. If you're not sure yet, then either one of you. For CEO position, probably going to be more important. But with a co-founder, yes, you can switch in these roles. If it's a very important investor, both of you should be on a call.
I'd like to hear your thoughts on valuation. We know that raising too much too early kills stuff, but how do you come to a right amount or balance amount so that you're not eating too much equity?
So there are several ways on how to approach your financials. So first of all, you want to obviously understand how much, understanding first of all, how much you need to raise. That comes from your use of funds, what you're going to be spending money on. You want to also look at your runway. So ideally for you, if you're raising your first round, which is like going to be pre-seed angel stage, you want to buy yourself 6 months to a year, ideally a year and a half, but for angel raise, usually projects trying to get 6 months and go straight after a seed raise after a couple of months. In terms of how to understand, so you need to understand who you would need to hire, and you don't want to go too crazy because again, you want to be very wise with your resources. Pre-seed round for majority of projects should focus on building your first MVP and getting market validation. So it's essential first trials with your target audience. And for that, you don't need to have a super robust and fancy solution. It can be, I don't know if you've ever seen the first version of Airbnb. It was the ugliest platforms. It didn't have a direct payment solution. People had to pay in cash when they will arrive to a property. And that's enough. That's enough for you to start getting data from your first users. So try to be a bit more conservative with how much you need. See on what are the base qualifications, like in terms of human resources that you would need, people to hire. You might not need someone with a fancy marketing background. You might not need much of marketing budget. You might not need sales budget. Your previous focus should be on actually getting a market validation. Because if you can come to investor and say, hey, we got all these numbers, market really loves us, we're going to kill it. It will be easier for you to raise a significant round, have at least a year and a half runway, and focus on advancing your solution. And then you can hire, obviously, marketing, sales team who will help to sell what you already built. But at the beginning, you need to build the project and show that it's actually, that the market actually cares about it and it makes sense.
And is there like a reference to each round? Like how many activity? I see a lot of people doing like 20% per round.
So I would recommend first round, I wouldn't try to give more than 10% of equity in the pre-seed. It can go a bit more depending on, obviously, on the project and industry, because you need to benchmark to similar projects. If I'm telling about these numbers, it's more relevant like to tech, Web3 space. If we're also experiencing way tougher market conditions, then of course the number can go higher. So you would need ideally to benchmark the projects that are raising at the current state. You can look at the Crunchbase. Crunchbase actually disclose a lot of data. If some of your friends, colleagues, or VC funds have a premium subscription, ask them if you can get access to that premium subscription, actually compare yourself to potential competitors. But you can also find a lot of information just by Googling your competitors and see if they raised and at what valuation they raised. But you can also find investors who might not be interested directly in your specific niche, but have a good understanding of a market situation in your industry, and you can just ask them for feedback, because on a daily basis, they will be receiving a lot of applications that they might not even care about, because again, it's outside of their focus, outside of their scope, but it might correlate with what you're working on, and that information might be really valuable. Yeah.
Good question. How much would you give away in terms of equity with friends and family?
Well, again, like it should come under same category with angel investors. So you don't want to give away too much, but also there is situations when like your friends and family can actually be involved and help you to build this project. So it depends like on the value they're bringing. If they're just giving you money and like they never hear back from you, then of course you want to come up with a similar ratio as any other angel investors that will be coming in. Maybe you'll have a little bit more favorable terms. But of course, their interest is not necessarily getting like a crazy amount of your equity. They want to support you. They probably, like some of the friends and family would just give you a loan and not necessarily like equity based. If you can get a loan is better, like from friends and family, and you can give them advisory share. So there's different ways on how you can arrange it. It depends on relationships and also values they're bringing. But there are cases when someone's, I would say like brother, is a great engineer and wants also to work in the seas, but he's not going to stay maybe with the project long term, but at the beginning, his expertise will be super valuable. So of course, you want to count it in. So there's different ways to approach it, but if you don't see any additional value, I would approach it similar way as angel investors, just because again, you need to be careful about your cap table. And you had a question?
I have a question about projections. I'm an angel investor with a very large angel group, and we look at a lot of decks, of course. And on the projection side, it's almost always the same. They're obviously very early, so maybe they have a little bit of traction, and they like 2x next year, and then it goes, whoop, and my eyes glaze over on like extreme growth. And I want to give feedback, but I always say, you can justify how do you justify these numbers. But if you have any other thoughts on that.
Yeah, so what I recommend founders is to do research. So your projections are not just like numbers that I think I'm going to earn that much. And I'm just like putting it in Excel, putting like, I want to have a 20% year-over-year growth, or I want to have 100% year-over-year growth. You need, of course, to justify these numbers. If you're saying that like my solution is absolutely unique, there is nothing like to benchmark it to, it's wrong. Because there's always an alternative. Until your project came to market, people were using something. Like Airbnb didn't reinvent the whole hospitality industry, right? They just made certain ways simpler, but there were already other options. There were offline markets where people could also sublet their places. There were hotels, and that's also your benchmark. So you want to find other projects in a similar industry, established projects, and benchmark to their growth scenarios. So you can actually, and there's a lot of projects that have public information. Crunchbase is also, again, a good source for you to see like how they were raising money. Then you can go and do more research. Now with ChatGPT is way easier. You can actually ask for some previous like user data, other media resources that we're publishing, and project receiving, I don't know, like additional like 1 billion users. So you can actually start benchmarking and see how this market is growing. Then you can find the market research. Let's say in the AI space, right? LLMs is a big market. So you can also see like a potential growth of our whole like LLM market. So you can benchmark it to your project. You can see, okay, the whole industry growth rate is estimated at like 25%. So we're probably going to go like with this number. So you always want to justify every assumption that you add to your financial projections should have a logic. And you ideally want to reference them to other reports, research that you were using. You can even have a different scenarios. We usually build several scenarios with founders. A more optimistic, more realistic, and a risk scenario, which of course, like you don't want to show like a crazy bad numbers, but you want to show like some other competitors that are not maybe like super famous and what revenues they also generated. So you want to show good numbers, but logical numbers. That's it. And there was a question from, yeah.
engineer and build a company is very easy to come up with a roadmap and execute. But with fundraising, it always seems like, at least for me, you're just doing it because you go into an event, you want to meet an investor. There's nothing planned. There's no like, here's how many investors I want to talk to today. Here's how many I want to convert, etc. Do you have any tips to organize outreach, whether it's outbound or inbound, and how to close that funnel, how to bring them down the funnel?
So fundraising is again, it's kind of a full-time process. So there is no, I would say, a life hack on how to do better. What I'm always advising is, again, to build a list of, let's say, 50 investors that are investing in your industry, that potentially interested in your project. Then you want to start categorizing. You want to put a priority on 10 investors who are not because you see that they're really big names, like let's say A16Z, right? I just want to raise from A16Z because everyone else wants to raise from A16Z. But you need also to understand the likelihood of you raising based on your connections and on your network. So first 10, 15 investors who you want to prioritize are investors who are not only bringing your great expertise and going to make a big difference for your project, but also investors who you are likely to raise from. And you want to spend most of your effort on these investors. You want to actually find out where they are, who are decision makers. You want to have conversation from different angles. You want to do extra steps on reaching out to them and building relationships. For other investors, I would say you can send your materials, you can find their emails, contact information. Just make sure, again, your email is very concise and very short. Because otherwise they're not gonna read it, they're just gonna put it in a spam box. So make sure that you categorize investors and put a lot of efforts on people who not only you care about, but who potentially can care about your project. Yep.
Tell us about brand.
Previously, you talked about speed versus quality, and you also mentioned an example of a company who was basically the competitors all compete them. So just kind of curious about, like, is that because they didn't grow as fast as your competitors, or like how do you find like good quality versus like great speed? It could be a competitive market.
Yeah, absolutely. So I think like the main problem was, and I saw it not only with this project, unfortunately, a lot of startups who are starting with a new idea and the market is pretty empty. So they're saying like, okay, like we're getting all the users, we're the first ones, there's not going to be any competition, we don't need to put much effort. So at some time, founders tend to slow down a little bit just because there's a lot of factors to that. Like building a startup is really exhausting. You have always ups and downs. If you think that all projects that succeeded, they had just everything growing, users coming, investors bringing money. No. A lot of these projects actually were on a brink of failure. A lot of founders were about to give up. A lot of founders had meltdowns, and that's a very common story. So of course, for that reason, when you see that, oh, things are coming a bit easier for me, a lot of founders tend to slow down. They also try to like figure out more solutions. They're also first in the industry, so certain things takes a bit longer for them to figure out. So they're looking at, for example, they're testing a new business model or a new feature. There is no alternatives that they can look at. There is no competitors that they can look at. So they're trying to test it with the market. And by the moment when they figure it out, okay, this feature actually works really good and we should focus on this feature. Competitor really can replicate it. They don't need to go through all these extra steps. They can just see, okay, this business model works. They figured out functionality. We know how to make it even better. We're going to launch in a few months. So that's also a big problem of that. Yep.
Also about grants. Getting grants. Is that a good idea before even talking to VCs?
If you can get free money, yes. I would never say no. Just the problem with grants, I would say it's more, especially like in the Web3 space, right? It's more on the protocol sides. I think a lot of protocols are not managing their grant programs well, just because there is no KPIs and they're not getting enough return on their financing. But for founders, of course, I mean, if there is no obligations for you to necessarily deliver something, you don't want to get maybe a grant from a protocol that is not feasible for what you're building. Because if it does make sense from a technology perspective and according to like a grant KPIs, you will have to do some integration. It's going to be a waste of your time because you're going to spend additional time and development, which also costs you money, even not directly in cash, but it's your time. You're going to spend it on all these integrations. But if they're just willing to give you money for you to test out something and it doesn't take much time, I would never say no, because if there is an opportunity on the market, of course it can help you, and you're not trading your equity, you're not pretty much owes them anything. Of course, it's not advice, and I'm just saying that that's I would say a loophole created by poorly managed grant programs. And more questions?
Just kind of curious about how to build or maintain a good reputation as a founder. You previously mentioned that being friendly to the questions, etc. But considering like business can possibly fail, and how these founders will maintain their reputation and start their next round or stuff like that.
So failing a project is not necessarily something that investors are not expecting you to do. Like when they see and invest in the founders, they already assume that there is a very, very high chance that this project going to fail. So they're not going to be really heartbroken and offended as long as like you didn't take money and just disappeared and like stopped doing this project. If they see that you were actually putting a lot of efforts, but for multiple reasons, like market conditions, or there can be like, I don't know, you lost a big contract that affected everyone else, you ran out of cash, and there's a bunch of different things that can happen that leads to a failure of project. But if they see that you actually wanted to build it, you were in a good phase, you put a lot of effort, they will never be heartbroken. And in many cases, investors actually going to invest in you for your second project or maybe even for a third project. I know a lot of our investors who are saying we actually prefer founders who already failed a startup just because they learned it hard way and they're still in the game, and that means the next time they're going to build it. It might not be their second project, but maybe a third one going to succeed and turn into a unicorn because they have this experience. So don't be worried about it unless, of course, you're not doing something that can directly damage a reputation. There was a question from, was there? Yeah. For teams, yes. So exits, if you have previous exits from any of your team members, you want to put it first because you want to see that you already successfully built and executed a project. You also want to see that you worked on a specific, in a specific space or on a specific application that is relevant for your business for long enough time for you to get expertise. You also want to show maybe your personal background, like what led you to create this project, why you're personally passionate about it. They also want to see that you have enough qualifications. So when I, for example, look at their team slide and I see that, okay, so let's say it's a fintech application. Let's say it's like a payment app, not even crypto, let's say a traditional payment app. I want to see, of course, strong development team, and I want to see a technical co-founder because it's a technical project. So I want to make sure that the core team, the founding team has enough expertise. I want to see that one of the co-founders have background in the payment applications before working for neobanks, any other fintech startup or bigger company, and are doing similar things to their current project. I also want to see someone from compliance that not necessarily in a founding team, but maybe part of at least advisors, or ideally some legal officer who you have on a quick call, because that project will deal with a lot of licensing, regulations, and compliance nightmare. So I want to make sure that you guys sorted that out. And of course, I want to see more technical team members who are not necessarily already co-founders, but I want to make sure that technical team is strong because, again, you're building a technical application.
This successful exit that you mentioned, I don't understand why. Say someone exited successfully, cashed out 50 million, and then why would they come back to you and ask for $500,000 again? Is there any logic to what is successful exit?
You mean like a founder that already did? Yeah, so I mean, in many cases, you don't want to necessarily invest your own money like in the project. You will probably put some money in to start the operation, but you're not probably going to go for like angel investors and asking for 100K. People with successful exits are like, especially very like reputable big brand names, they'll go after very big rounds. So they will go to bigger players because again, it's not about money. You can put money in, but if it's you and a couple of your team members, you still want to have more advice and expertise. And in many cases, they're not replicating exactly the same solution. They're building something new, which they might not have enough expertise yet. So they will go to VC funds that have enough like ideas and understanding of how this market works. Let's say you build like a transportation app before and you did successful exit and now you want to do something else in the healthcare industry. And of course, it's not necessarily an industry that you already knew about. Maybe you're passionate and have some other background, your co-founder have in-depth expertise, but you want to go to investors who have network in this specific segment. Is there more questions? Okay. Okay. Yeah, I'm also happy to chat. I'm going to be here. So if you guys also want to chat, feel free to stay here longer. Thanks everyone for coming today. I will share the presentation with everyone who attended, and the video will be published at some time. I don't know when my team decides to publish it. Thank you.